Machine Trading, Deploying Computer Algorithms to Conquer the Markets. Written by Ernest P, summarized by detailed book summaries. Don't forget to subscribe. Chapter 1. The Basics of Algorithmic Trading. Picture this. You're sipping your morning coffee, the markets are open, and yet, you're not stressed. You're not glued to a screen. You're not frantically second-guessing yourself over a trade. Instead, somewhere in the cloud, a trading system you've designed, coded by your own hands, is making decisions for you. No emotions. No hesitation. Just logic, data, and code doing their job. This is the future that many dream of when they first hear the phrase, algorithmic trading. But before the magic begins, there's something deeper, something more grounded that needs to happen. And that's exactly where Ernest P begins his journey in machine trading. Not with high-frequency trading or machine learning wizardry, but with something far more essential, the foundation. P starts by clearing the fog that often surrounds this space. Algorithmic trading isn't some exclusive club for PhD physicists and math wizards holed up in hedge funds. The gates are open now. With free or low-cost platforms, APIs, and programming tools like Python, R, and MATLAB, almost anyone with determination and discipline can step into the arena. That accessibility, however, creates a temptation to rush. But P cautions, slow down. First, understand what you're building. Because an algorithmic trading system isn't just a few lines of code. It's a business, a living system, and it starts with an idea. Now imagine you've got one. You've spotted a pattern. Maybe it's a moving average crossover. Maybe it's an anomaly you noticed in a small cap index after earnings reports. Whatever it is, you believe it works. That belief needs testing, and not just casual eyeballing but rigorous data-driven backtesting. Here's where P dives into the technicals. He explains the process. Define your trading universe, craft a hypothesis, and test it using historical data. It sounds simple, but here's the trap: curve fitting. The most seductive danger in algorithmic trading is building a model that performs brilliantly in the past but falls apart in real time. Why? Because it was designed to match history too perfectly. P warns, your strategy doesn't need to be perfect in backtesting. It needs to be realistic. So how do you keep it real? You include transaction costs. You factor in slippage, that little ghost that eats into every fill. You model latency, the time it takes for an order to actually hit the exchange. These aren't technical annoyances. They're the difference between a theoretical edge and actual profitability. Many traders learn that lesson the hard way by losing money. P's message is clear. Treat your backtest like a lie detector, not a cheerleader. But building a strategy isn't the end. It's the beginning of a much larger machine. Once the backtest shows promise, you enter the paper trading phase. Here, your code trades in real market conditions but with fake money. You're watching for breakdowns, misfires, and edge decay. P recommends at least 3 months of paper trading before risking capital. Why? Because live execution introduces variables no backtest can replicate. There are API errors, network delays, market behavior that doesn't follow historical norms. And more than anything, there's you, your reaction, your patience, your discipline. As he paints this picture, P emphasizes that algorithmic trading is just as much about infrastructure as it is about ideas. He walks through what you actually need: a data provider like Quant or IQ Feed, a broker with an API, such as interactive brokers, and a machine, virtual or physical, to run your system 24/7. He explains how to deploy your code on cloud platforms like Amazon EC2, how to log activity, monitor errors, and build in fail-safes so that if your internet goes down, your trading system doesn't crash with it. He's methodical yet grounded, always returning to the same core message. Don't overcomplicate what doesn't need to be complicated. Build only what you understand. Use existing tools when they work. Focus on creating alpha, not reinventing infrastructure. And all through this, there's a quiet philosophy in P's voice. He's not hyping get-rich-quick promises. He's not seducing you with dreams of Lamborghinis bought on leveraged crypto bots. Instead, he's mentoring you, coaching you into thinking like a builder, an operator, a risk manager. He makes you ask, am I building something sustainable or just something that looks good on a chart? The real gem in this chapter isn't any specific piece of code. It's the mindset. P is planting a seed. The idea that successful algorithmic trading isn't about chasing edge. It's about managing uncertainty. You're not predicting the market, you're engineering a response to it. And like any good engineer, you need systems, guardrails, and diagnostics. You need to measure everything. You need to assume your model is flawed and your assumptions are brittle. Because that humility, that's your edge. That's what keeps your trading business alive. By the time you finish this opening chapter, you realize that Chan has done something subtle and powerful. He's reframed what it means to be a trader. Not a gunslinger. Not a gambler. But a builder. A quiet craftsman who turns code into capital, logic into leverage, process into profit. And suddenly the path ahead, though filled with challenges, feels navigable. Not because it's easy, but because it's honest. The tools are within reach. The blueprint is on the page. Now it's up to you to build the machine. Chapter 2. Factor Models. There's a moment when you begin to realize that trading isn't just about spotting a signal or executing a well-timed order. It's about structure. It's about understanding what drives returns, what patterns are persistent, and what stories the market tells through numbers. That moment often comes when you discover factor models. And in this chapter, Ernest Chan gently but powerfully walks you into that world. Not with overwhelming jargon, but with quiet conviction that these factors, if used wisely, can become the bedrock of your trading machine. A factor at its core is a measurable trait, something about a stock or asset that historically helps explain its performance. Think of it like a DNA marker. Why did stock A outperform stock B last year? Maybe it was cheaper. Maybe it was more volatile. Maybe it had stronger earnings momentum. These aren't guesses. These are factors. And they're everywhere, waiting to be discovered, ranked, and traded. Chan opens with the classics, value and momentum. Those timeless forces that have powered many a hedge fund model. Value asks, is the stock cheap relative to its fundamentals? Momentum asks, has it been doing well recently, and might that trend continue? Simple questions, yet behind them lie decades of research, billions of dollars in returns, and countless models built to capture their edge. But how do you, the individual trader or small quant team, begin to use these forces systematically? Chan brings you step by step into the methodology. You choose a universe, perhaps the S/&P 500, or a set of ETFs or futures contracts. You calculate factor values for each instrument in that universe, using data that would have been available at the time. You rank the assets and then build a portfolio, long the top performers on your factor, short the laggards. You're not trying to predict exact price movements. You're trying to tilt the odds ever so slightly in your favor repeatedly. And here's where Chan's experience shows. He's not just telling you what to do. He's warning you what to avoid. Survivorship bias, for example. That's when you build your model only using stocks that still exist today, ignoring the ones that disappeared along the way due to bankruptcy, delisting, or acquisition. It's an easy mistake to make, and it renders your backtest almost useless. Then there's look-ahead bias, where you accidentally use data in your simulation that wouldn't have been available in real time. Both traps are subtle, deadly, and incredibly common among novice quants. Chan doesn't leave you stranded, though. He suggests ways to mitigate these issues, using point-in-time data, cleansing your datasets, validating your logic. But more than that, he teaches a mindset. Assume your model is flawed until proven otherwise. Validate not just on the training set but on unseen data. Stress test across regimes. Ask hard questions. And always treat your backtest as a hypothesis, not a conclusion. As the chapter deepens, Chan broadens the view. He shows how to go beyond simple one-factor models into multi-factor territory. You might combine value and momentum, or add a volatility filter, or filter by liquidity, sector, or earnings revisions. Each factor adds nuance, diversification, and hopefully robustness. But there's a catch. The more factors you use, the more chances you have to overfit. It's a delicate dance between simplicity and sophistication, between underfitting and curve fitting. Chan helps you walk that line. What's especially striking in this chapter is how flexible the framework is. You're not limited to fundamental or technical indicators. You can use options data like implied volatility skew as sentiment proxies. You can create bespoke factors based on Twitter sentiment, ESG scores, supply chain disruptions, or any alternative dataset you can quantify. Your imagination becomes the real limit. And in this way, you stop thinking like a traditional investor. You start thinking like a data scientist, a detective even. Still, theory means nothing without implementation. Chan discusses the use of regression models, linear, logistic, or even more advanced machine learning, to extract relationships between factors and returns. But he never lets you drift too far into abstraction. He always pulls you back to practicality. Does this factor work out of sample? Does it survive transaction costs? Is the signal stable or noisy? Is it capacity constrained? These are the questions that separate ideas from businesses. And then, almost quietly, he drops one of the most powerful insights in the book: that building factor models is not a one-time event. It's an ongoing process of research, validation, decay, and renewal. Markets evolve. Behavior shifts. What works today may not work tomorrow. And so, your job as a machine trader is not just to build but to monitor, to observe, to adapt. By the end of this chapter, your screen doesn't just show a matrix of numbers anymore. It shows patterns. It shows behavior. You see how stocks move not randomly, but in clusters, following rules, breaking them, reverting to mean, chasing trends. You begin to trust the data, not the story. You realize that factors aren't about prediction. They're about probability, about crafting a statistical edge. And if you manage that edge with discipline, it can compound over time, quietly, patiently, relentlessly. In this world, intuition has its place, but it must bow to evidence. Biases are acknowledged but not obeyed. And strategies are built not on hope but on hypothesis. This is the world of factor models. And now that you've stepped into it, there's no going back. You're not just trading anymore. You're thinking like a quant. Chapter 3. Time Series Analysis. The deeper you go into quantitative trading, the more you begin to realize that the market has a memory. Not a perfect one, not always reliable, but something is definitely there. You look at a chart tick by tick, bar by bar, and you feel it. Patterns unfold, cycles emerge, and past behavior seems to echo in the present. You start to wonder, if the market has memory, can we model it? Can we listen carefully enough to detect rhythm, to decode structure, to anticipate behavior? That's the premise of time series analysis. Not to predict the future with crystal ball certainty, but to understand how the past can meaningfully inform what might come next. And so begins a more technical, more mathematical, but no less human chapter of the machine trading journey. At first glance, time series data doesn't seem too complicated. A list of prices over time, open, high, low, close. Maybe some volume. But the moment you ask, what can I learn from this? The real complexity begins. Ernest Chan guides us gently but firmly into the world of autoregressive models, and he does it without condescension. AR models, he explains, are built on the simple idea that today's price may depend on yesterday's price, or the day before. This sounds intuitive, even obvious, until you try to measure it. You learn to quantify lag. And before long, you're staring at autocorrelation functions that reveal just how far memory stretches or doesn't. When those correlations are strong, you might be able to trade the pattern. When they vanish, the series might just be white noise. But the world is rarely so neat. The market doesn't only move because of its past prices. It moves because of shocks, unexpected news, large orders, changing sentiment. To model that kind of randomness, Chan introduces moving average models. Not the smoothing kind traders often use, but true statistical moving average models that treat randomness as a structured input. Combine autoregressive and moving average models and you get ARMA, a staple of time series modeling. But when data trends, when it drifts over time in a way that can't be modeled by mean reverting logic, you need to first difference it to make it stationary. That leads to ARIMA, autoregressive integrated moving average models, tools designed to handle data that grows or shrinks over time while still exhibiting meaningful patterns. As you dive deeper, the models evolve. Chan introduces vector autoregression, or VAR, which deals with multiple time series simultaneously. Imagine modeling not just the S/&P 500 but also oil prices, interest rates, and the VIX, all feeding into each other, all affecting the same system. VAR allows you to express the joint behavior of these series, not as isolated threads, but as part of a complex weave. It's here you start to appreciate just how interconnected financial systems really are. Stocks don't move in a vacuum. Currency, macroeconomics, sector rotation, all of it swirls together. And yet, even VAR assumes that the relationships are linear and constant. But what if the forces driving prices shift over time? What if relationships break, reform, evolve? Here, the state space model enters like a quiet breakthrough. It assumes that what we observe, the price, the volume, is just the surface. Beneath that lies an unobservable state that governs behavior. You can't see it directly, but you can infer it. You can estimate it. And you can track it in real time using a Kalman filter. Think of it like GPS. You don't always know exactly where you are, but you use signals, weak, noisy, but steady, to stay on track. A Kalman filter helps your trading model do the same. And then comes volatility. Price movement is one thing, the way that movement fluctuates is another. Markets don't tremble gently. They spike. They surge. They go quiet for months and then explode in a single day. To handle that, Chan introduces GRCH models, generalized autoregressive conditional heteroskedasticity. That's a mouthful, but the idea is profound: volatility clusters. Periods of high volatility tend to follow other high volatility periods. GRCH models let your system adapt to this reality. When risk is rising, the model scales back. When the coast is calm, it takes more exposure. It's not emotional. It's systematic. But as powerful as these tools are, Chan is quick to point out that they're only as good as their assumptions. Every model is a simplification. A backtest is not a promise. So he emphasizes diagnostics. Residual plots, Ljung box tests, AIC values, tools not to make you feel smart but to keep your model honest. Is the data truly stationary? Are the residuals uncorrelated? Does your model actually explain the variance? Or is it just fitting noise? These are the questions that separate theory from utility. And then comes the human side again. Because you can get lost in the elegance of these models, tweaking lags, optimizing parameters, building what looks like a brilliant machine. But the real challenge isn't just statistical. It's practical. Can you trade this? Will it survive slippage, commissions, execution delays? Can it adapt when the Fed surprises the market? When China bans crypto? When a meme stock disrupts an entire index? Time series analysis gives you tools, but it's your responsibility to wield them wisely. Chan knows this. He reminds you not to fall in love with your model. He reminds you that walk-forward testing is critical, that you must train and test on different periods, that you must never assume stability where none exists. And yet, when done right, something magical happens. Your models start to feel alive. They respond. They update. You feed them new data and they shift slightly, quietly, but with purpose. You're no longer just observing the market. You're interacting with it. You're building systems that don't just guess, they adapt. Systems that are grounded in math, but sensitive to change. Systems that remember but also learn when to forget. By the end of this chapter, you see the market differently. It's no longer a random sequence of bars and candles. It's a conversation across time. Sometimes it whispers. Sometimes it screams. But always, there's something beneath the surface: patterns, pressure, rhythm. And your time series models? They're not oracles. They're translators. Tools to help you hear more clearly, respond more intelligently, and trade more deliberately. And in that clarity you find an edge, not in prediction but in preparation. Not in knowing the future but in being ready for it. Chapter 4. Artificial Intelligence Techniques. There comes a point in every trader's journey, especially one immersed in algorithms, when you realize that manually crafting every strategy, every condition, every rule, starts to feel like writing with chalk on a wet sidewalk. The market shifts. What worked yesterday fades tomorrow. And with so many variables, volume, volatility, macroeconomic shifts, sentiment, correlations, regime changes, you start to feel like you're just reacting, always a step behind. So the question bubbles up quietly, insistently. What if the machine could learn? What if, instead of telling it what to do, you could teach it how to think? That's where artificial intelligence enters. Not as magic, not as fantasy, but as a powerful extension of your reasoning, your strategy, your edge. Ernest Chan doesn't dive in with hype. He doesn't promise that machine learning will make you a millionaire overnight. Instead, he speaks with the calm clarity of someone who's seen it all. The power, the promise, and the many traps. He begins by distinguishing between the types of machine learning most relevant to trading. The first is supervised learning, where a model is given input features, predictors, and a known output, something to forecast. The idea is simple. Feed the model enough examples, let it learn the mapping from input to output, and then use it to make predictions on new, unseen data. It could be something as binary as will the stock go up tomorrow, or as continuous as how much return will this asset generate in 5 days. You start with familiar algorithms. Logistic regression, decision trees, k-nearest neighbors. These aren't black boxes, they're logical structures, often transparent, interpretable. A decision tree might split based on volatility. If it's above 3%, do one thing, if not, do another. It's almost like the model is writing rules for you based on the training data. And if one tree is helpful, a forest of them is better. That's where ensemble methods like random forests and boosting come in. They train many models and aggregate their predictions, reducing overfitting, increasing robustness. But as you test these, you start to notice a problem. The model fits the training data well, maybe too well. It seems to know the answers before the questions are asked. But when you let it loose on fresh data, performance crumbles. That's overfitting. When your model memorizes the past instead of understanding it. Quant is relentless on this point. Machine learning models are powerful but fragile. You must use cross-validation, walk-forward testing, and be ruthless about separating training data from testing data. Just because your model did well last quarter doesn't mean it has any business touching your capital this quarter. As you refine, you find that the number of features you feed into the model matters just as much as the algorithm itself. Throw in too many predictors, some redundant, some noisy, and the model chokes. It sees patterns that aren't real. So you learn to select features carefully, to eliminate multicollinearity, to use tools like principal component analysis, PCA, or regularization techniques like lasso and ridge regression. The model improves not because it got smarter but because it got simpler. Then you step into deeper waters. Neural networks. At first, they sound mysterious, layers of nodes, activation functions, weights updated through backpropagation. But as Quant explains, they're just complex function approximators. They don't require you to specify the form of the relationship between input and output, they learn it. This freedom allows them to capture nonlinear interactions, subtle shifts in regime, and interdependencies that simpler models can't see. But freedom is dangerous. The more flexible your model, the easier it is to fool yourself. Neural nets need vast amounts of data, careful tuning, and most of all, discipline. Still, they open doors. You start thinking not just about supervised learning but reinforcement learning. Instead of passively predicting an outcome, now your model is an agent. It interacts with the market. It chooses actions, buy, sell, hold, receives feedback in the form of profit and loss, and updates its strategy. It's not being told what to do. It's discovering what works through trial and error. Sounds magical. But Quant is quick to remind you. This is one of the most difficult machine learning areas to implement in live trading. Rewards are sparse, market environments are non-stationary, and bad policies can quickly become expensive. Yet, if done correctly, reinforcement learning offers something rare. A model that adapts not just to data, but to consequences. In parallel, you explore Bayesian methods. They don't just output a prediction, they output a probability. Instead of saying, stock A will rise, they say, there's a 65% chance stock A will rise by 1%. That nuance is powerful. It allows for smarter position sizing, better risk modeling, and more informed trade decisions. And when uncertainty is high, Bayesian models can stay cautious. They're not overconfident. They're measured. But Quant doesn't let you fall in love with the technology alone. He circles back to implementation. How do you deploy a machine learning model in production? You can't just plug it into your broker's API and hope for the best. You need monitoring systems, logging, latency handling, live data feeds. You need to know how the model behaves under stress. You need to account for transaction costs, order slippage, and liquidity constraints. You need controls like kill switches and thresholds, because models like traders can panic under pressure. They can behave unexpectedly. And unlike humans, they don't have instincts. They do exactly what they were told to do, even if it doesn't make sense anymore. So you build a framework. You version your models. You track performance across environments. You create metamodels that monitor the main model. You don't just build a predictor, you build an ecosystem. And through it all, one idea keeps surfacing. Intelligence is not the same as complexity. Sometimes the simplest model, logistic regression on well-engineered features, will outperform a deep neural net trained on noisy signals. AI is not about chasing the latest trend. It's about knowing your data, understanding your tools, and building systems that learn responsibly. By the end of the chapter, you feel it. A shift. You're not just writing code. You're training intelligence. You're building systems that grow, evolve, and respond. You're no longer guessing at rules, you're discovering them. Quietly. Systematically. And with each new model you build, each test you run, each out-of-sample result you validate, your edge sharpens not just because your machines are learning but because you are too. Chapter 5. Option Strategies. Every great trading idea begins as a whisper. An instinct, an anomaly, a flicker on a screen. But in the world of machine trading, that spark means nothing until it faces the gauntlet of backtesting. A backtest isn't just a trial run. It's a simulation of your strategy's heartbeat across the harsh, unrelenting timeline of financial history. It's where your elegant logic, your polished code, your clever algorithms all collide with reality. And more often than not, reality bites. But that's exactly the point, because if your strategy can't survive history, it doesn't belong in the future. Ernest P opens this chapter not with excitement but with a warning. Backtesting, he says, is both essential and dangerous. Done poorly, it will deceive you with illusions of profitability and robustness. Done properly, it becomes your first and most loyal critic. It's not about building confidence. It's about uncovering flaws. And so, the real purpose of a backtest is not to prove your strategy works, but to give it every possible opportunity to fail. Because only if it resists failure under scrutiny does it deserve your trust. It starts with data, the lifeblood of any model, but raw market data is rarely pristine. Survivorship bias lurks in most datasets, showing you only the winners that are still standing, hiding the delisted, the bankrupt, the forgotten. If you test your equity strategy on today's S/&P 500 list, you're cheating. You're trading in a world that never had to face the attrition of time. And it gets worse. Corporate actions like dividends, splits, spin-offs, if not handled with precision, skew your results. Even simple timestamps can deceive you if they don't reflect what was actually known at the time. That's why P insists on point-in-time data, especially when working with fundamental or classification information. The rule is simple but ruthless. Only use what was available when the decision would have been made. Anything else is hindsight in disguise. Once your data is sound, the next layer is strategy logic. This is where your signals take shape. Are you going long on momentum? Shorting mean reversion? Are your rules daily, intraday, event-driven? But logic on paper is not logic in the market. You must be brutally clear. When do you enter? When do you exit? What are your constraints? Every ambiguity becomes a hidden assumption in your code, and hidden assumptions lead to fatal flaws. Did you assume unlimited liquidity? Instant fills at closing prices? Zero slippage? If so, you're backtesting a fantasy, not a strategy. The next trap is perhaps the most subtle. Look-ahead bias. This is when your strategy unknowingly relies on information that would not have been available at the time of the trade. Maybe you use the closing price to generate a signal, then execute it at that same close. Seems harmless, until you realize that in live trading, you wouldn't have known that closing price until the bar had already ended. You can't make decisions using data from the future, even if that future is only minutes away. And this is where discipline becomes everything. In a good backtest, the clock is sacred. The sequence of events must match reality, not just in price but in knowledge. Then there's the illusion of execution. Many backtests assume perfect fills, but real markets are messy. You place a market order and it slips. You send a limit order and it doesn't fill. Liquidity dries up. Spreads widen. The true cost of trading is more than just commission. It's the friction of reality. P emphasizes the importance of modeling bid-ask spreads, latency, partial fills, market impact. Because when your strategy trades size, it becomes the market, or at least it disturbs it. And if your backtest ignores that, it's lying to you. With all this in place, you finally arrive at performance evaluation. But even here, total return is not enough. A strategy that makes 30% annually with 25% drawdowns may look good, until you have to live through those drawdowns. The Sharpe ratio begins to matter, not just how much you made but how smooth the ride was. The Sortino ratio, which penalizes downside volatility. The the maximum drawdown, and perhaps more importantly, the length of the drawdown. Because in real life, time hurts as much as loss. And a system that loses for 9 months, even if it's profitable over 10 years, will test your patience, your capital, your sanity. Then we arrive at the most painful part, overfitting. It's the invisible seduction, the trap that every quant faces when tweaking parameters, optimizing signals, testing variations. You change the moving average from 20 to 18. Sharp ratio improves. You switch the signal delay from 1 day to 2. Max drawdown drops. You feel like you're getting closer to the truth, but you're really just bending the model to match noise in the data. Chan doesn't mince words here. If you optimize too much, you're curve-fitting history. And curve-fitted models don't fail slowly. They blow up. To counter this, he introduces out-of-sample testing. The idea is simple. Divide your data into training and testing periods. Build the model on one, validate it on the other. Then rotate, walk forward. Each new segment becomes a new test. The model is retrained, retuned, and tested again. This simulates how a real trader would adapt a system over time. It prevents your model from getting too comfortable with one regime, one set of conditions. And if the results hold across different periods, different volatilities, different market moods, then you might have something real. Monte Carlo simulations deepen this test. They take your strategies, trades, and reshuffle them. Randomize the order. Simulate what would have happened if the same trades had arrived in a different sequence. Why? Because luck matters. A strategy that earns 10% from 100 trades might feel safe, but what if all the losing trades came first? Would you have stuck with it? Could your capital have survived? Monte Carlo tests reveal the range of possible outcomes, not just the average. They show you how fragile or robust your strategy really is. And still, Chan pushes deeper. Walk-forward optimization takes it a step further. Here you build a model on the first few years of data, optimize parameters, then test on the next few months. Roll the window forward, repeat. Each slice reflects a new market, a new mood. If your parameters hold or adapt without overfitting, you've found stability. But if they collapse, your model was only pretending to be robust. Finally, Chan returns to philosophy. A backtest is not a crystal ball. It's a hypothesis generator. It doesn't predict the future. Prepares you for it. You're not trying to prove that your system will always work. You're trying to understand the boundaries, when it might fail, why it might fail, and how you'll respond. It's a stress test of logic, of statistics, of faith. And perhaps more importantly, it's a stress test of you. Because once you launch your strategy, the real test begins. It won't match the backtest exactly. It might underperform for months. It might scare you. And if your trust in the model comes only from its past performance, without understanding, without a strong process, without discipline, you'll abandon it. But if your backtest was honest, realistic, and brutal, if it didn't flatter your ego but instead forged your confidence, then you'll be ready. Not because the model is perfect, but because you've trained yourself to handle imperfection. By the time you finish this chapter, you understand backtesting is not a technical step. It's a way of thinking, a way of debugging your beliefs, a way of protecting your capital before it ever touches the market. Done right, it's the most valuable trading tool you'll ever own. Not because it tells you what to do, but because it teaches you how to think critically, patiently, and probabilistically. Chapter 6. Intraday Trading and Market Microstructure. It doesn't matter how elegant your strategy is. It doesn't matter if it's backed by years of research, built on a mountain of clean data, and boasts a sharp ratio that would make even Renaissance technologies blink. If you can't execute your trades efficiently, accurately, and on time, your alpha won't just fade, it'll vanish. This is the harsh truth that separates simulation from reality. You can have the smartest brain in the world, but if your hands are clumsy, you're still going to drop the scalpel. And in algorithmic trading, execution is your hand. It's where the rubber meets the road, where your ideas step into the world and try to breathe. Ernest Chan doesn't romanticize execution. He demystifies it. Because while signal generation and strategy design often get all the attention, the glamour, the headlines, execution is where most quant systems quietly bleed out. You don't feel it right away. It's not dramatic, but it's slow, corrosive. A few cents here, a few BPS there. Over time it adds up. And before you know it, that promising backtest is a losing live portfolio. The simplest way to execute a trade is with a market order. Just smash the button, grab the best price available and be done. But that simplicity comes at a cost. When you hit the market, you pay the spread. Worse, if your order size is large relative to available liquidity, you start to move the price. You chase it and you slip. What looked like a 0.3% edge becomes 0.1%. Or zero. That's why experienced quants prefer limit orders, placing an order at a specified price or better. You cap your slippage, but in return you risk not getting filled at all. This trade-off between certainty and cost is at the heart of execution. You're always walking a tightrope between speed and stealth. Place a limit order too far from the market, and you're invisible. Too close and you're exposed. Everyone can see you. And in today's hyper-competitive markets, someone is always watching. Your limit order becomes a signal in itself, one that high-frequency traders can sniff out, front-run, or lean against. To combat this, modern execution relies on tactics, algorithms that slice large orders into smaller parts and feed them into the market over time. The most common ones are TWAP and VWAP. Time-weighted average price evenly distributes your order over a set period, while volume-weighted average price adjusts your pace based on real-time market volume. If the market is active, VWAP trades more. If it's quiet, it holds back. These algorithms try to minimize your footprint to blend into the flow. But they're predictable. Sophisticated traders can spot them and exploit them. That's where adaptive execution comes in. These are smarter, stealthier algorithms that don't follow fixed schedules. They respond to market microstructure, order book depth, trade frequency, spread dynamics. They sniff out when liquidity is real and when it's just a mirage. They jump in when the time is right, then disappear. They're not just executing, they're playing a game of survival. But none of that matters if you don't understand the mechanics of where your order goes. When you send a trade through a broker or API, it's routed to an exchange, or perhaps a dark pool, a liquidity provider, or an internalizer. A smart order router decides where to send it. Some brokers have sophisticated routing logic. Others don't. Some prioritize execution speed. Others prioritize rebates. If your system isn't aware of these nuances, you're trading blind. A penny saved on fees might cost you a nickel in slippage. Chan emphasizes the importance of modeling these costs realistically. Backtests that assume perfect fills, no latency, and zero transaction fees are fantasies. In reality, every trade costs something, not just in commissions but in the bid-ask spread, in market impact, in delay. You need to simulate these frictions in your test environment. Estimate slippage based on historical spreads and volatility. Apply realistic delay assumptions. Include the broker's fee schedule, exchange rebates, even the hidden costs of rejected orders. Because when your model finally goes live, you don't want surprises. You want certainty. Execution isn't just about pushing trades out. It's also about managing risk in real time. Orders can get partially filled or not filled at all. Exchanges can reject orders. Brokers can throttle your flow. And when something breaks, because something always breaks, you need logs. You need error handlers. You need recovery logic. This is where your trading system becomes more than just a strategy. It becomes a machine humming along with resilience, self-awareness, and just enough paranoia. Latency is another dimension altogether. If your strategy depends on reacting quickly, especially in intraday or high-frequency settings, milliseconds matter. Nanoseconds matter. You might not have the luxury of a slow Python script or a bloated web-based dashboard. You'll need asynchronous APIs, parallel processing, lightweight data structures. Or maybe you go all in and co-locate your server at the exchange's data center. That's the arms race world of ultra-low latency trading, where speed is alpha and software is built like weapon systems. But for most of us, building a strong execution pipeline is less about speed and more about precision. It's about designing a system that reacts appropriately to each scenario. Market open, trading halts, volume surges, stale quotes. It's about making sure your orders reflect the right position size, conform to exchange rules, respect rate limits, and don't double count. Execution is about trust. Can you trust your system to behave correctly under pressure, to obey your constraints, to stop when things go wrong? That's why Chan stresses the importance of paper trading. Before you risk a cent, you run your system in simulation mode, connected to live data, placing mock trades. You test every edge case, partial fills, rejected orders, network failures, timeouts. You log everything. You watch how your system behaves not just when things go well but when they don't. This is how confidence is built, not from optimism but from battle testing. And finally, there's the human side. Because at some point, execution becomes personal. When a trade fails to execute as expected, when your P&L drops because of a silent error, when a bug costs you real money, you learn. And those lessons stay with you. You start coding more defensively. You build in safeguards. You stop assuming that markets are fair or stable or clean. You realize that every successful trade isn't just a signal working. It's your entire infrastructure operating flawlessly, quietly, in the background. So by the time you finish this chapter, you don't see execution as a technical detail anymore. You see it as the nervous system of your trading operation, the invisible real-time process that transforms code into capital. And once you master it, not just in theory but in practice, you're no longer just a quant with a good idea. You're a trader, a builder, a system architect. You've moved from the drawing board to the battlefield. And you're ready. Chapter 7. Bitcoins. There's a moment in every trader's journey, often after a euphoric streak of wins, when a cold, unexpected loss hits. Not just any loss, but one that shakes your faith in the entire system. And that's when you realize the truth. Trading isn't just about finding edges. It's about surviving the periods when those edges don't show up. Ernest P takes this lesson to heart in Chapter 7. This isn't a chapter about making more money. It's about keeping what you've already earned. And in a world where machines execute your trades with mathematical precision, risk management becomes more than just a line item. It becomes your system's immune system. Quiet, often invisible, but absolutely vital for survival. You see, automation doesn't eliminate risk. It amplifies it. When you're trading manually, your instincts might hold you back from pressing buy in a sketchy moment. But machines don't hesitate. They do what they're told no matter what. So when things go wrong, and they will, an algorithm without constraints can turn a tiny edge into a raging fire. It's not about if your model fails. It's about how fast it'll bleed, and whether you're able to stop it before it drains your capital. That's the essence of risk management. P begins not with complex models or formulas, but with a mental shift. He challenges the very idea of what risk means in trading. It's not just volatility, or some abstract Greek symbol in a formula. It's everything that can go wrong, from the market suddenly moving in sync against all your positions, to your own code misfiring in production. It's the risk of being too confident, the risk of trading too big, the risk of letting performance blind you to hidden exposure. And most dangerously, it's the risk you haven't thought of yet. So how do you manage this invisible monster? P offers several layers, starting with position sizing. It sounds basic, but it's often the very first thing that derails traders. Take too small a position, and your edge disappears into transaction costs. Take too large a position, and your drawdowns become emotionally unbearable. He introduces the Kelly criterion, a mathematically optimal way to size bets based on edge and odds, but quickly tempers the excitement. The full Kelly formula is aggressive and assumes you know your true expected return and variance, which you probably don't. That's why many seasoned traders use a fraction of Kelly, half Kelly, quarter Kelly, or abandon it entirely in favor of volatility targeting. If you size your positions so that each trade risks this leads into the importance of diversification, not just across symbols or sectors, but across strategies. One of the biggest risks isn't losing on a single trade. It's having all your trades lose at the same time because they share the same hidden dependencies. In a crisis, correlations spike. Things that seem unrelated like gold, tech stocks, and crypto suddenly start moving together. That's correlation risk, and it's deadly. So P suggests building a portfolio of strategies that behave differently in different market regimes. Mean reversion, momentum, volatility breakout, stat arb, market making. Each has strengths and weaknesses. Combined, they can create a system that's more resilient than any one strategy on its own. But even with diversification, you still face tail risk, those low probability, high impact events that most backtests gloss over. The 2008 crash, the COVID panic, the Swiss franc unpegging. In backtests, they show up as one bad data point. In real life, they feel like chaos. This is why P urges you to stress test your models. Simulate what happens if your positions suddenly gap down 10%. What if liquidity vanishes? What if all your orders get delayed by 5 seconds? If your model can't survive those scenarios, it's not ready. Because real markets don't just test your strategy, they test your assumptions. Then there's the danger lurking within your own system. Model risk. This isn't just about code bugs, though those matter too. It's about trusting a model too deeply when it's built on weak foundations. Maybe it's overfit to a specific dataset. Maybe its edge was only valid in a particular volatility regime. Maybe it relies on economic indicators that lag or revise retroactively. Whatever the source, when your model breaks, it rarely sends a warning. Just stops working. That's why Quant recommends ongoing walk-forward testing, regular performance monitoring, and out-of-sample validation. You need to treat your model like a living thing, constantly checking its health, adapting to new data, and being ready to pull the plug if needed. This brings us to operational risk. It's not glamorous, but it's real. Imagine you send a market order, and your broker's API crashes mid-execution, or a typo in your code doubles your position size by accident, or a trading halt kicks in and traps your position. These are the things that don't show up in backtests because real losses. Quant insists on designing fail-safes, redundant logging, kill switches, maximum position caps, timeouts. If your system goes off script, it shouldn't keep trading. It should stop and alert you. And then Quant discusses one of the most overlooked forms of risk, psychological risk. You can have a model that's perfectly sound, but if you're not emotionally prepared to endure a 20% drawdown, if you haven't felt that pain before, it'll mess with your decision-making. You'll start second-guessing the model, turning it off, tweaking it midstream, all of which usually makes things worse. That's why your risk limits shouldn't just be theoretical. They should be built around you. Your personality, your capital, your ability to sleep at night. Risk management in this sense is deeply personal. To tie it all together, Quant encourages a mindset shift. Don't treat risk as the opposite of return. They're not enemies, they're twins. Every profitable system contains risk, and every risk can be structured intelligently. You're not trying to eliminate it. You're trying to understand it, to respect it, to box it in. And once you do that, your confidence as a trader grows, not because you expect smooth sailing, but because you've already prepared for the storm. By the end of this chapter, you begin to see risk not as a red flag, but as a compass. It points to the places you need to fortify. It tells you where your system is weakest and where you need to grow as a builder. More than that, it teaches you humility, because no matter how brilliant your model is, the market always has the last word. And if you want to trade for the long haul, you need to be ready to listen to your models, to your metrics, and to your gut, especially when the winds change. Chapter 8. Algorithmic trading is good for body and soul. There's a unique feeling that creeps in after you've done all the hard work, researched a solid trading strategy, coded it, tested it, and watched it succeed across historical data. You're tempted to think, this is it. I've cracked the code. But that feeling is deceptive. Because even after all that, you're only halfway there. What comes next is what really separates a trader with a clever script from one running a reliable machine. This final chapter isn't just about adding a few last pieces to your system. It's about transforming it into something alive, something that can operate independently, adapt to reality, and endure when the market turns on you. Ernest P eases you into this realization not with fanfare, but with quiet urgency. At this stage, you're not building a model anymore. You're assembling a pipeline, a complete, self-sustaining system that doesn't just generate signals but handles data, sizes positions, places trades, manages risk, logs activity, and reports performance. And it does this not once, not manually, but every day on its own without human intervention. That's the real dream of machine trading. Not to make a lot of trades or even a lot of money, but to build something you can trust to think and act for you while you sleep, work, or live. It begins with automation, not just at the trade execution level, but across the board. Your system should fetch its own data, whether daily or intraday, and it should do so cleanly and redundantly. If a price feed fails, it should have a fallback. If the feed returns corrupted or missing data, it should catch that too. Because one bad data point could skew your entire forecast. You don't want your model chasing ghosts because the API hiccuped at 3:47 p.m. So every part of your data workflow needs to be resilient, repeatable, and observable. That's your foundation. Next comes the engine of the system, your strategy logic. This is the code that receives data, generates forecasts, and produces buy or sell signals. But now, you can't just think in terms of backtest. Your model is going to live in the real world. It has to handle unexpected values. It has to be memory efficient. It needs to run in real time or near real time, depending on your strategy's frequency. It should work with modularity too, models as plugins, so if one stops working, you can swap it out with another. Chan emphasizes, don't build a castle around one model. Build a system that hosts models like rooms in a house. Make it easy to evict one and bring in another without having to reconstruct the whole structure. When your model gives a signal, what happens next is just as crucial: position sizing. This is where ideas become exposure, and exposure becomes risk. Are you using fractional Kelly sizing? Scaling to recent volatility? Limiting per asset capital allocation? Your code needs to compute target weights, compare them to current positions, and generate delta orders, the net changes required to get from here to there. Because rebalancing isn't about rebuilding your portfolio. It's about adjusting it surgically, intelligently, cost-effectively. Those delta orders flow into execution. And this part is where the real-world messiness enters. The market is fast, fragmented, and unpredictable. So your execution system has to be smart and reactive. Do you cross the spread with a market order? Do you place a passive limit order? Do you route to the exchange with the lowest fee or the highest fill probability? Execution isn't just an API call. It's a living negotiation with the market, and it should adapt based on conditions. If orders aren't getting filled fast enough, your system should know to escalate. If a broker's API fails, it should reroute or pause. The goal isn't just to trade. The goal is to trade with the least possible cost, risk, and information leakage. After trades are sent, you log everything. Positions, fills, timestamps, errors, system status. You don't log because you hope something will go wrong. You log because one day something definitely will. And when it does, you'll want a trail to follow. Your logs are not just records. They're your audit, your memory, your forensic toolkit. And you can't stop there. You must monitor. Live. Always. Your system needs dashboards. Not fancy ones with pie charts. Clear, clean views of latency, P/and L, drawdown, exposure, execution quality, error rates. When your drawdown hits a threshold, you get an alert. When latency jumps above a limit, your phone pings. When your system misses a data update or fails to fill an order within 5 seconds, it pauses and waits for review. You don't do this because you don't trust your system. You do it because you trust the market to test it. Chan also walks you through infrastructure where your system lives. Do you run it from your laptop? Probably not. A cloud server? Sure. A colocate server next to the exchange? Maybe if you have the capital. But whatever you choose, your code should be portable. It should run on any machine, restart after a crash, recover from a network failure, and never assume that the next second will go smoothly. Because in trading, the next second never owes you anything. Then there's the kill switch. Every serious system needs one. And not just a big red button you press manually. You need automated guards, capital limits, loss thresholds, error count monitors. If 3 orders are rejected in a row, shut down. If drawdown exceeds 10%, pause and notify. If account cache deviates from internal records, lock trades until reconciled. You're not just coding a trader. You're coding a trader with boundaries, instincts, and discipline. A machine that can say enough before the bleeding gets fatal. As the chapter closes, Chan doesn't offer a final formula or a final warning. Instead, he leaves you with something more powerful: perspective. Machine trading is not a shortcut to wealth. It's not a replacement for skill. It's a craft, process, a journey of building systems that reflect the way you think about risk, structure, edge, and integrity. You learn more about yourself with every model you kill, every trade you lose, every bug you fix at 2 a.m. This is the point where it stops being about math. It becomes something else, something more like philosophy. You're no longer just asking, how can I profit? You're asking, what can I build that lasts? You realize the real win isn't a sharp spike on your equity curve. It's the quiet consistency of a system that works while you sleep. One that needs less and less intervention over time. One that surprises you less and less. One that teaches you more than it takes. And that's the magic of this book, really. It doesn't promise perfection. It offers a blueprint. Not just to trade better, but to think better. To build like an engineer, to protect like a risk manager, and to reflect like a philosopher. You walk away from this chapter not with fireworks, but with something far more useful: clarity. The realization that you are not here to chase every signal. You are here to architect a machine. One that survives. One that evolves. One that trades like you would, only better.